Hey gang, Uncle Doug here, dropping some mortgage knowledge on you and some market trend knowledge on you to understand a little bit about my credentials. In the last 30 years, I've been a mortgage banker and broker. I've been a realtor in 2 states, a property manager, a certified residential appraiser. I've done some stuff, so I've got a unique vantage point. Let's talk about some of this stuff. So, national trends are great. It tells you generally what's going on. So there's some national trends right here. Fannie Mae, which is a national aggregator of loans, Mortgage Bankers Association, National Association of Realtors, they're all expecting increases in values. Now, if these numbers are 2%, 4.3, 4.8, that means there's some areas that are going to probably be much, much higher, and then some areas that are either going to be depreciation, so negative appreciation, or static values, right? But you, as a consumer, you're buying in a microcosm of the national. If you are buying in Phoenix, that's what's important, and then you're buying in a subdivision in Phoenix, or a sub-city, like Queens Creek, maybe outside Phoenix, or you're buying La Jolla Shores in San Diego, or you're buying in Henderson, which is in the Las Vegas Valley, but it's its own city. So we need to get granular to get good information. I am happy to help, and I'm here to help you with that. Reach out to me. You can find me on all the social media platforms. Google my name, Doug Waldman. You'll be able to find me all over the place. And let me find out exactly what I can do to help you out to get some good data. Because this is worthless to you other than you should know that the general trend is going up. Because if we look at, for example, there's some areas in Vegas that are not going up at all. But let's look at Henderson, for example. Henderson is growing gangbusters. And it has since 2019. In early 2019, the average house out there would have been 400 and maybe 25, and now it's gone up 58% in the last 5 years. And you're looking at houses in the 675 range, and that's even after COVID. So here's COVID right here. Prices went nuts when the rates slowed down in May of 2022. Things cooled off a little bit, but they came right back in a matter of a couple of years. And now we're at the top of the market again. And rates, which everyone likes to talk about rates and, the Fed's going to do this. We don't know what the Fed's going to do because we don't know what the inflation's going to do. And that's what they're deciding as the metric for whether or not they need to just continue rates where they are, increase them or decrease them. And say what you will, but the market, the overall economy is zipping along. Sure, there was quote-unquote inflation. Personally, I think that was corporate greed, because now all of a sudden, Walmart, Target, McDonald's, a bunch of other companies just announced that they are lowering prices. Yet, during the inflationary period, they had profits well above inflation, which means they were screwing you and me, the American public. This is not a political thing. This was corporate greed. This was capitalism run amok. And we all dealt with it. So that's off. I'm now off my soapbox. I'm back. I'm okay. Thank you. But in general, the rates, we don't control the rates. They're going to do what they're going to do. And I think it is a fool's errand to try and time the rates. I talk to a lot of people. They're like, I know rates are going to come down. You don't know jack. Right? All the talking heads all thought that the rates were going to come down. The Fed was going to stop it. They didn't stop it. The Fed said that there were going to be 5 or 6 rate drops this year. We haven't seen one yet. And inflation is still zipping along. Trying to change and cool off the economy using interest rates is like trying to turn a super tanker by dragging your hand in the water. Not super effective. People are still buying. They're buying on credit. We got, after COVID and getting shut in, people are just wanting stuff, and they will not be denied. And they're getting it. But let's look at the rates, because everyone's like, the rates were, the rates, the 2s and 3s. First of all, that was an aberration. The lowest rates have ever been were in the 2s. So if you live through that cycle, That was not reality over the last 50 years. If you look at the 50-year average, we've had some highs. That wasn't reality either. But if you look at the general trend, the average has been somewhere in here, right around 7.4 is the median rate. So we're right at the median rate right now. Now, will rates come down? Maybe. Should you wait? No. Let me explain. Today's home value. We're going to look at a couple of houses. I just used round numbers in this graph real quick. This spreadsheet I made. I did have to look up the two payments. The payments are not programmed in, but everything else is somewhat programmed. And I just used round numbers. So, I know, I can make the same graph and give you the same data if you're putting down 3%, 3.5%, 5%, down payment assistance programs, all the way up to, jumbo loans. I can put this together for you very quickly. Reach out to me. I can help. And let's find out what your market's doing and if it pencils for you to wait or not. So let's look at a couple of scenarios here. So the first one, $500,000 house, $100,000 down, $400,000 loan amount. Let's say the appreciation in the market's 5%. Okay. Not super hot, but not cold at all. So your house, if you buy it this year, is $500,000. You buy it next year for $525,000. The difference in a 6 to 7% interest rate, 7% a house, $400,000 finance, principal and interest would be $2,653. If you did time it and rates dropped, you'd be at just shy of $2,400. So you're going to save $255, $3,000 a year before tax write-off. Now again, if you're in a 20% tax rate, you're sheltering another $600 of this. You're only paying $2,400. But the alternative is you got to pay an extra $25,000 for that same house next year. Let's look at a jumbo or a high cost loan, depending on where you live. $1 million loan, $100,000 down. Let's say $900,000 loan amount, so $1 million value, 10% down, $900,000 loan. Let's say you're appreciating at only 2% a year. You still get an opportunity to pay 1.02 for that house next year, or you get a shelter a whopping $7,000. But what happens if the market's hot? What happens if the market's 7.5% out there? So now you can either save $7,000 maybe, or that you live in a hot market and that the prices are going to go up, and you get in now at $1 million, and next year that house is worth 1.075. You just made $75,000 because you were smart and you got in now. House prices have consistently gone up over the last 100 years in the United States, or at least 50 years, 60 years. They really got zipping along after, the 70s and 80s and have exploded, right? We all hear the stories of our parents. Oh, I bought a house for $30,000. Yeah, now grandma owns a house at $1.2 million, right? So it's gone up thousands of percent in that timeline that she's owned it. Get in the game. That's all I can tell you. Reach out to me, Doug Waldman, Uncle Doug, drop in knowledge, here to help. MLS number 248175. These are all estimates, and we're assuming the loans all cost the same if you're comparing apples to apples on these rates. So the APR would be identical, just a different rate of the 7%, 6%, because we didn't add any extra fees or anything like that for you trolls out there. But reach out to me. Let's chat. I'm here to help.